Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Thursday, October 17th, 2024. It's 10:19 now, 10:19 a.m. as I'm starting the video. We're going to just cover a whole potpourri of different things here. I've got some individual stocks, bonds, international stocks, sectors, indexes, but I'm going to tell you what order. We're going to go quick look at the retail sales report, which came out today. I'm going to talk on that real quick. I had a trade idea. I noticed a couple yesterday, the day before, and it's moving, so I want to share it with you. It's a volatile little high risk thing, LAC. We'll get to that. So I'm going to try to do it in this order, and it's just how I have it scratched down here. There's no rhyme or reason to this. We'll look at the indexes real quickly. QQQ. Look at LAC. That's a trade idea, potential trade idea for you. Netflix are reporting tonight. It's an active trade. And we also want to do an update on treasury bonds, natural gas, XBI, the biotech. Somebody asked about that. I'll give you an update on that's an active trade as well. PGJ as well as FXI. Those are the two big China ETFs. SOX, the semiconductor sector ETF, NVIDIA, SMCI, and then GDX gold and silver. That's a whole bunch. I'll try to get it in as quick as possible. Won't spend too much time on any one thing, but just wanted to give you updates there and a couple new trade ideas. All right, so today, before the market opened, we had retail sales, and the market rallied on it, beat expectations. That is, just so you know, that it is it's quite a bit subject to revisions. It's the U.S. Census Bureau conducts retail sales. They're responsible for that report, and they use a lot of sampling and modeling techniques. So you get some kind of variance in there, and it's often subject to revisions. However, let's take it on face value. Let me just show you this chart here real quick. So what you note on this, you can see the recessions are here in the gray shaded boxes, shaded areas. That was 2000, around the dot-com bubble era after it popped. The Great Recession right there, and then COVID and what I call Ursa Interruptus. Yeah, bear market and a recession that would have been a lot worse, but we saw unprecedented fiscal and monetary stimulus that made it a quick one. It was over. If you blinked, you missed it, but it was still a recession. And again, these are by the NBER. They get to subjectively declare a recession based on whatever they want. It's not any firm criteria. The old traditional method is 2 quarters of declining GDP. But either way, what I wanted to just show you, because I do this because I turn on, the only time I'll watch the Bloomberg or CNBC, usually when there's market breaking reports or a Fed meeting, I want to hear what's going on. And then before I have time to shut it off, I had Sarah Eisen or whatever her name is. My God, the cheerleading over this. She spent about 5 minutes rambling on how bullish retail sales are, the consumer still spending. And we do know consumer spending makes up over 2/3 of GDP. So that is a thing. All right, let's just look at the chart here. All right, so I just highlighted the recessions. You can see them there. You can see them in the gray boxes. And again, when I look at a chart, I don't have to study this one deeply. What stands out to me is in an economic expansion, retail sales are rising, and month to month you get the little blips, if you want to call it, but the trend is pretty clear. And at some point, and again, you don't have to be an expert technician, I don't think, to see what I see here. It peaks, and then it's not just one of those little month-to-month gyrations. It's a clear trend. It's leveling off to slightly lower, and then invariably, without exception, a recession is followed. Now, again, I'm not going back. This is as far as I can go back here, I believe. I'll click on it in a second to see if I can go any farther. That happened here as well. You see retail sales after a clear uptrend, right? This is a period of, that goes on for, I'd have to zoom in. It's at least a year or two where you see it stops going up. And again, without any variance there. There was COVID. COVID came quick, and that was kind of a one-off black swan event. But here's the current trend, and it matches what we saw. What's to the right of this. Again, this is not, to me, this is not it's clearly indicative that retail sales have peaked and have been trending lower. In those month-to-month gyrations, like the beat today is, it doesn't change its trend. In fact, there's a clear leveling off, as we saw before every other recession. Here again, COVID was kind of a little bit different with the pandemic and all that, and an immediate shutdown of the economy. Yeah, that's it. All years. That's as far back as I can go. All right, let's move away from that. Alrighty, we have in about 6 minutes coming up natural gas, but let me stick to the order I told you I would cover everything in. Here's QQQ, no change really. We did, we're still in that market top range going back all the way from late June. It's where we peaked before on the daily chart. We're looking at a 60-minute here, but you don't see it. But that was that was just what got us in that first wedge break there. Bearish engulfing candle on the on daily chart of QQQ. Swung it down, covered in reverse on August 5th lows, and we're back to in that market top range. So again, no change there. If you're brand new to the site, just check out any of the recent videos. Really can't spend much more time on this. We've been kind of slogging around sideways here. Still have the divergence, and my outlook hasn't changed. Okay, let's roll into those trade ideas in no particular order, other than what I stated earlier. LAC, I caught this one the other day, had a price alert, I believe, go off right here yesterday. Nice big divergent low right there. It's a low price sucker, so I don't know if I'm just going to reserve it and use it as an official trade idea, but this is Lithium Americas Corp. And anyways, nice breakout. What I plan to do is check out. I do have a watch list, and I haven't had time to do it, of lithium stocks. I'll check it out and see if the sector confirms. You know my thing. I like to see. I often say birds of a feather flock together. If just one stock in a sector is breaking out, especially a sector with high correlation between the components, but the rest aren't, and they're, let's say, bearish charts or at resistance or whatever, then you may want to hold off. So I'm just throwing it out there for those interested. You can see my levels on the chart. Just screenshot the video and see max potential target I have right now is 776, which would be a heck of a run, be up at 120% from where it's at today. But we are coming up on the first resistance slash potential target, which is 382. You also have the 200-day simple moving average and exponential, and that's what's capped it since it's been in this bear market that it's in. So keep that in mind, that either of those. So it's quite a few resistance levels coming up. But again, constructive chart. I'll get back to you if I go over the sector and I like or don't like what I see. I'll let you know. Netflix reporting tonight. This one is an active trade idea. Okay, had to pause the video. You might have heard some little chimes going off a minute ago. That was a data disconnection error from another brokerage program I'm running on another monitor. And internet's out. Hashtag Comcast sucks. So I have to pause the video here, wait for internet connection to come back online. I wish there was a better alternative where I'm at. So let me pause the video and wait till I have internet access to resume. So these charts will load. Okay, back online. Comcast confirmed the outage, no ETA. Blamed it on severe weather, and it's a bluebird day out there, a little bit breezy, so I don't know what those jackasses are talking about. But tethering off my cell phone, that's fine. We'll just do that. Finish this video. All right, so on Netflix, somebody asked the other day, and it was just dancing on that 700 support, and it's clearly taken it out. Now, the thing is, and I'm going to say it took it out today, and they report tonight. It's always a crapshoot when you go into earnings. It can go either way. And I have a thing I made up in trading, make a lot of stuff up. One of them is called Know Your Security Rule. It's so old. When I was a stockbroker, Know Your Client Rule. You have to know their financial background. Well, you have to know what security you're trading. Be aware of its past. Netflix is what I call a gappy little sucker. It has a very clear history of making big gaps for whatever reasons. Well, the reasons are some companies do a great job of managing earnings down to the T. They have it to an exact science, and there's really no surprises. And then you have others like Netflix, for whatever reason, you can see these gaps. I'm almost certain they're going to coincide with earnings reports. So big gaps. So that's when I say know your security. If you're going to trade a stock, look at the chart. If you're not familiar with the stock, just go back. You get a quick glance. If you start seeing big gaps all over the place, and especially at periodic intervals, which look about every 3 months or so, that's earnings. That's an 18% gap right there, gap up. So you closed right here that day, and then you opened up here about 17% gap up. There's a gap up in the tune of 12%. So if you were short the stock then, you would have gotten your clock cleaned. It would have bypassed any reasonable place stop. There's a 10% gap down right there. And so there it is. So you guys decide whether, and here's one right here. If you were long, you woke up to a 36% gap down, again, blowing past any reasonable stop. There is no way to protect against that. I'm just going to digress for a second because I've talked about this in the past. If you're new to trading, you need to understand how stop orders work. Basic, keep it simple. There's two main types: stop loss, stop limit. A stop loss order, if you have a good to cancel, will fill once that stop price is hit or triggered. Meaning you trade through there. Let's say your stop was right here, you were long. A stop loss order, upon triggering the stop price, immediately converts to a market order. That means your order didn't fill here because that gap, stock never traded there. There's a big gap. It filled down here the next day. It got in line with everybody else's orders at the open. There were order imbalances, and that's what exaggerates and causes these large gaps. And the stock dropped like I said, about 36%, whatever it was there. I'm going to turn these volume price histogram lines down. And so say, okay, Randy, I won't use a stop loss order. I'll use a stop limit because that says sell me at and only at this price, whatever, $300, whatever. But then those get bypassed because a stop limit order says you can fill me at or better than my stop price, but no worse. So then what happens is your order is unfilled. You still have a stop limit that will sell you at 300, but only 300, no better. And so you continue to watch your losses build. Ultimately, before all is said and done, you lost half your money on that. If you had a reasonably placed stop in earnings there, because the stop limit never got filled, your losses continued to mount and bottomed out after you lost about half your money. And again, that's from right here, not from the top. So, all right. So you guys decide how you want to trade it, what you want to do. I'll leave it on as an official trade because it's triggered. And I also say that, randomly, if I didn't have an opinion on the chart, I'd say it's 50-50. You can show, like I just showed you, there's some big gaps down, some big gaps up. It's a crapshoot either way. However, this chart to me has a bearish technical posture. So my guess, I think the odds are over 50% that the next move will be to the downside. So there it is. Enough on Netflix. Again, if you're in it and how you want to manage it, that's up to you. If you're risk adverse, either hedge up with some options or just exit the position and wait until afterwards. And I can tell you this: if it's big gap down, you're probably going to hit my second target. I think this is where we'll hit tomorrow. You have the 200-day moving averages in T2, and otherwise you'll take that stop out. And the other thing too is I don't react much to what happens in the over-hour session, but it's not a double-edged sword. I try to use it to my advantage. What I mean by that is I will loosen up stops when I hold something going into earnings, and because the goal in any trade is not to get stopped out for a loss. So the initial reaction sometimes is these stocks will go one way after earnings and then reverse, especially in the after-hour session. You get these big moves. Now, if that big move hits price target, let's just say my preferred target right now was T2. Then if T2 is hit in the after-hour session, I'm going to use that to get out. That's what I was targeting, so I want to get out. My goal is to hit a profit. However, I might, if it shoots up right after hours, exceeds the max stop, I might hold off and suspend those stops. Wait till the regular session, see how it's trading. Plus, those stops aren't going to get filled in the after-hour session unless you have a stop limit order and you've marked it good to cancel and also available. You have to check the box to allow it to be filled in the after-hour session, so you might want to avoid that. Stop loss orders will never be filled in the after hours because those you have to use limit orders in the after hours session. Okay, enough on that. Probably spent more time than I wanted to, but hopefully, it's important that you know these things. By these things, I'm referring to the various order types, because this one of the critical, one of the key pillars of successful trading is loss and mitigation and proper management of positions. And so you have to know your type of order, especially with equities too. Again, like you're prone to all those gaps. That's one reason I like futures. Trade around the clock, not really prone to gaps, especially the indexes. Alrighty, moving on. ZB, Treasury bonds. I think there's a good chance for a bounce trade. I took some just before the video here at that 120.55 support. Let's see if I can continue to bat 1,000. We shorted the last short trade. We entered right here on the break of this uptrend line. We covered on T4. Final target was hit. Then Monday we went long there, and yesterday I told you I decided to pull the plug right there at the highs, and that was a perfect entry, perfect exit on the last trade, and a near perfect entry and a near perfect exit on the previous trade. And so I just looking to game a bounce here, and that's really more active trader stuff. I don't call it an official trade. I'll throw it away if I don't like it. I didn't take much, but I think we might just get a little bounce off that level. And then on TLT for your ETF traders, that also coincides with this 94-ish support right there, and there's a gap right there just below on TLT. So I'm not going to give it much room. Just think we could get one little bounce and then another jog down. Next up, natural gas, UNG. I got one out to you today, shared my thoughts. Yesterday I said, not so good that the futures took out those previous two lows, although UNG didn't. Remember, UNG does its best to track natural gas as any ETF or ETN will, but it can't be perfect because it has expenses, fees, it's rolling the different futures contracts. As a futures trader, we're trading, most of you trading the most liquid contract right now, the Novembers, and then we roll that, and then we go into the Decembers. Anyway, I don't want to expand on it too much more. Like I said, despite my comments yesterday, I like it here. Remember, it's also at long-term support, coming off long-term support with a bullish case. I covered it quite a bit recently. And so, all along, it's been trade, T5. I told you we had the negative divergence. And that was back then in recent weeks. Said, you could use this as a stop loss level. You could have used this as a stop loss and then buy down to, but not below that level. And either way, so call it a new trade, call it a re-entry of a previous trade, call it an add-on if you're still holding this thing long-term. That's why there's 101 ways to skin a cat, and there's 101 ways to trade. So just throwing out objective entries. And then again, like I said earlier, your stop loss is going to depend on what you're looking for. If you're looking for just a quick run up to maybe the $15 level again or that previous high, that's going to determine where your stop is. If you're going up for these longer targets, you might give it a little more room. Natural gas futures. That's NG. So far, so good. But we really, like I said in yesterday's video, if we can recover this, that's those two previous lows, then this whole thing becomes a bear trap, aka false breakdown. Short sellers pile in, and then when you see that, they get squeezed out, and then the bulls, or just flexible traders like me, opportunists, will come in and small blood in the water, jump on that short squeeze and try to ride it up. But I like, me, I love my divergences. And like I said, longer term charts are still constructive. So either way, new trade looks good. And again, it can be a quick, you want to trade it. Natural gas is, still, it's, if nothing else, it's a nice trading vehicle. Just swing these divergent highs and lows. But there's also, as I've covered quite a bit in the last couple months, long-term charts are very constructive. We may be looking at a triple-digit gain here coming up in natural gas. So I still like it for a long-term trade too. Okay, somebody asked me about XBI this morning, or at least that's when I saw it. Still back testing, still a trade idea. Breakdown there. We're coming off that divergent high. Remember, it was a pretty much a big resistance here at about 103. Had a divergent high there. Had a nice correction, and even bigger. This is really an extension. It's really DH1 and DH2. First divergent high, second because it's an extension of this divergence that started and we had back here. It's only grown much larger, which indicates to me a much larger drop if and when it plays out. That's why we have more deeper, more aggressive targets, T5 all the way down here than that last drop. Even if we just get that, and that would take us down to T3, that's still 22% or whatever from the highs. I forget if we a little less if we shorted here. So, back testing, thing I always talk about back testing, it's objective. When you break down below a trend line or a rising wedge pattern like this, you have an objective short entry on the breakdown. Sometimes you never look back, but quite often you'll get a back test of the line, and that also offers an objective entry. And we bounced right off my S2 level. These were my first two support levels. So as expected. But what I like to see, because the problem with back testing, you can back test for a while, and you're going up. And if you're short, well, you don't want to be going up. What I like to see is an impulsive rejection off there. So that would be the first thing to help support, or maybe add on if you're scaling into this thing, or if you've passed, you're thinking about it. You want to see that rejection, and then of course a break below S2. And once that happens, you have the 200-day moving averages just below. Once that's all taken out, that 95-ish support, the 200 days, that should open the door to those deeper swing targets there. Let me update that China one. PJJ has fallen back below the trend line, but there's two that I watch, two big China ETFs. Remember, this is, I remember the day the stimulus was announced, it moved up. I almost threw it out to you as a trade idea then. It went up too fast. I didn't want to chase it. Sometimes the second mouse gets the cheese. So we bought it yesterday on the pullback there to the trend line. Your stop will be commensurate with what you're looking for. So it's just below that trend line now. However, the other big one in China, and I just went with PGJ yesterday because it was backtesting the trend line, is FXI. So FXI, I had a price alert set for this one, and that's when the stimulus came. It took out this really pretty decent resistance level right there. You can see that's kind of been the resistance for a while, and got a little ahead of itself. And it's back testing, so that's why that's still give PGJ a little room. Now, if FXI does this, it's not going to be good. Things aren't going well in China, but again, they just they announced a massive stimulus, and I don't even think they gave the details. Maybe that's why the market didn't like it. But China, those in power will do what they can do to juice the market. But like any trade, it either works out or it doesn't. So pick your stop based on your price targets, and use those OCO orders if you lack discipline. Like I always say, I think they're the best thing since sliced bread. OCO order, or also known as OCA. One cancels the other, or one cancels another. Same thing. Some brokers call it this, some call it OCA. And that's it. You put your price target, sell limit order if you're long at your price target. And then a stop loss order, and you set it, they're tied together, so one cancels the other. You're either going to be stopped out or your price target's going to be hit. You don't have to be in front of your computer. And what it does, it takes, for those that lack discipline, to get in a trade and you try to use mental stops, but you second guess it, or the other way around, you get a nice price target, you're looking for a 20-30% gain on something, and you get that 10%. Maybe you've been getting your butt kicked on another trade, so that one trade you're targeting 30% is up 10. You're going to book that profit just to keep it, and that's lack of discipline. You keep doing that, not sticking to your trading plan. Then at the end of over time you're not going to be successful. So that's where I like the OCO orders. Besides the fact, there's a hurricane coming, I set OCO orders and walk away, and I know I knew I'd be out of power and internet, and I at least had cell service this time around. Ian knocked out the cell towers, so if I had not gone into a hurricane like that, there's nothing I can do. When you're out of cell and home internet. Okay, let's go to that was China. Let's talk about the semis. So XX. This was a recent new trade here. We had this wedge pattern here, most recent divergent high. We've been building, building, building. It really should say DH1, 2, and 3. It doesn't matter. You can see the divergence line there. You also had divergence here across the board. You had this bearish rising wedge pattern. Breakdown, snapback rally, still looks good. No change, no reason to update or second guess that trade. NVIDIA, obviously a component of SOXX, and the biggest one. Still like it. We went down, we came close to T2. We're right back to where this trade was entered. It was on a breakdown of the wedge there, and so it's even. We made it ever so slightly marginal new high this morning. Still, it simply extended the divergence, and all we have to do now is break this trend line. Again, this can be a long-term trade. I have long-term targets on the weekly chart. I've been sharing since late November. I'm sorry, late November, late June. And those are still in play, I believe, unless we, start taking out that, previous high right there, and then some. We're getting close, but also this is a short-term swing trade with just 3 price targets, and that would you need to take out this uptrend line, and if so, that will be the catalyst to probably move down and hit that third and final near-term target. Obviously, if that goes, then that opens the door for the bigger targets, and we have the potential for a double top high. They don't report for a while, but we have a lot of other semis that are going to be reporting, and they could set the tone for NVIDIA. As well as big tech. More so is when Apple, or not Apple, but more so Meta and Alphabet. Alphabet's a big one, all in on AI. Many people, myself, think that's a mistake, that they're spending too much. They're not seeing the return on it. I can tell you that personally is, got a Pixel phone. I love it. They gave me free, in the latest Pixel 9 Pro. They give you 1 year of that Gemini AI. I tried. It does nothing for me. There's nothing, and things they call AI aren't even real AI. It's just advanced search features, the little gimmicks. That's me, guys. I know some people use AI, and I'm a big proponent, a big fan, not proponent, big fan of Perplexity, using that as an alternative search engine along with Google for certain things. I even have the Perplexity Pro. They call it AI. It's just an advanced search feature. It's really all it is. You can call it AI. You can call it, what are they going to start slapping the term AI on washing machines at home and everything, and people are jumping all over that. Anyway, you know me. I've been a kind of not a critic. I know there is artificial intelligence and there are things, but I think a lot of people got these LLMs, large language models, confused with true AI. Anyways, look, I'm fundamental rambling right now. All I'm trying to say is the big spenders, the ones that have really greased the wheels for NVIDIA, are those big mega tech companies. And we'll see when they report. So we don't have to wait. We'll have all the big tech companies, and maybe they'll give us some color in those earnings reports, and that may be that. So, but ultimately, then NVIDIA, after all the other big tech reports, they report. It's over a month from now, but. Anyways, that's it. One to watch, and I still like it on the downside here. I haven't commented much on SMCI. It's been kind of there. It's been kind of floundering around. We came within, close enough that you'd consider that first price target zone hit. Remember, it was a sold price target initially at 35.56, and I always say on all the trades on the right side of the chart, cover above. I list the actual support level that I'm targeting, but I always set my sell limit orders or buy limit order on short trades, a buy limit order above that, and above is going to be relative to the scope of the move. In other words, if you're looking at TLT, or Treasury bonds, ZB, you're talking basis points, a fraction of a percent, because I'm only usually going for 3, 4, or 5% total moves when I'm swing trading treasury bonds because they're inherently low volatility. So then you're going to, look for covering just a fraction of percent above support level when shorting, or selling a fraction of a percent below a resistance level when going long. On this, let's see, we came within 4%, and we had short entries on that one here. That was my initial one, shared that with you. Then here, along the way here, right there. And so, average cost on that trade, or profit was about 63%. So yeah, that is 4%. It was well within that range. So again, but it's semantics, whether you covered or not. Most importantly, let's talk about where it is now. This level here, 48, 40-ish level. I've had that level, created that back in September right there. I can see late September. It's been resistance. It was this reaction low. You also have a top of a gap right here. Let me highlight that as well at that right now. So this is a story. This is my quick take on SMCI. Got a gap there. You've got some resistance. If it pops that and the semis run, then this one might have a little room. They report on November 6th. However, I still favor, because I still have these deeper targets, and I do believe, especially if the SOXX trade pans out. So what we need to do is break this uptrend line. Just like NVIDIA, you have that minor uptrend line. Break that, we're going to go down. And being that we came close enough to consider the top of that zone hit and that initial price target right there, that kind of checks it off. It gives me that check box that it's already been hit, because again, relative to the scope of the move, that's close enough. And so that opens a door that will probably run down. The next major reaction will be at the bottom of that target zone, which is support around 30.85. And then, if we take that out, then that opens a door to T2 down here. All right, so there's your update. Oh, and you look at it from a trend indicator. The PPO on a lot of stocks works very well as a trend indicator. When you look at the zero line, every stock's different, so I'll sometimes draw the line. I'll sometimes take a horizontal line, put it a little bit above, a little bit below. I like to use the 9 EMA, which is your signal line, because that's the last of the two to cross. And so what it does, it helps define trends. And so, often the zero line does the trick, and it's simple. When your PPO is above it, you're in a bullish trend. When it's below it, here it was whipping down through, and that's a consolidation period. That's when trend indicators don't work well. You're not going to really, you want to stop using them as buy and sell signals when you've noticed a stock is consolidating or chopping around. It's during uptrends and downtrends that the zero line does a great job of delineating bull and bear trends. And so it said, okay, this was a bull run, be long and strong. And then we crossed there, and that was shortly after our initial sell signals came. And it's told me, this, at least the PPO has said, hey, we're in a bear market. And when you get that, just like in a bull run, pullbacks to the zero line often act as support on that, again, on the PPO. And so what this is a rally back to that level. We haven't crossed it. So that also says right now, hey, we're still in a bear trend. It's counter trend bounce. And if we get rejected, PPO gets rejected, we take that out, we go down, we keep the bearish trend alive and well. Okay, so there's your update on SMCI. Let's see what I have next. Let's wrap it up with gold, silver, and GDX, and we're doing pretty good on time. We're only 33 minutes into this. GLD, eking out. This is a daily chart. You had a hell of a bid since the breakout. Remember, this is kind of long-term, big picture. This was our previous bull market it peaked in 2011, followed by a bear market. Then we took that level out. We were consolidating right here. This was a major breakout right here. This was big resistance. It had tested those previous bull market highs. 193.13 was the magic number. Created that line back in May. And that was it. Once we broke it out, you can see how very well defined it was. It's been a steady run, but we still have a very clean uptrend line here on the weekly chart. It's going to trigger a pretty powerful sell signal, take us back to, I'm going to add one more line for you. This is just long-term stuff. I'm going to get to the shorter-term charts there in a second. There's that uptrend line right there. Then on the 60-minute chart, with still a short trade, we shorted it there, I believe, on the break of that bearish rising wedge. Like I said, I don't typically, I'll chart gold. I prefer to trade silver and GDX and or because you just get more juice. And that's it. Marginal second new, ever so slightly higher high. And you have that near-term uptrend line. So when that's broken, it should take us down. Once the secondary trend line breaks, it should bring us in down here to these 1, 2, 3 targets. And again, your stop is going to be commensurate with your price targets. I just showed you on the weekly chart, we could see a whole lot more if this trend line breaks. I could see a back test and still it'd be a hell of a drop, but it'd be about a 21% drop. I think there's a lot of hot money in gold right now. And I know the central banks have been buying. That's kept a bit under it. And a lot of retail investors. It's almost bubble-like right now with all the craze of Costco selling out gold coins and all that stuff, and people are starting to realize they're not as easy to sell. They're easy to buy with a couple clicks of your mouse and get you 5% back on your Costco credit card if you have that, and executive membership. But so it's been a good, easy to get in, and we'll see if what happens later on. Either way, that's the technical outlook. So let's talk about the metals and the miners, or the silver, the other metal and the miners. This is GDX. It's just been a great swing trading vehicle. It's in an uptrend, but you can see on this daily chart, there's your primary uptrend line. No bueno if and when that uptrend line breaks, just like gold. So watch that. And just like gold, it keeps, it has divergence building. Divergences are not sell signals. I'll repeat that. I say it all the time, but it bears repeating. Divergences, whether they're bullish or bearish, are not buy and sell signals. They're conditions. The conditions that once you get a sell signal, when you have divergence, that was a divergent high, that was a divergent. All these drops came after divergent highs. And again, I can put the little line there, and that's a divergent high there. But your sell signals, and we've been trading the miners and the metals on these long and short off these pullbacks, and then you go down to the 60-minute chart, and this is it. So we've had trades along here, short, long, short, long, short, long, short. That's it. Most recent sell signal was there. We went down. We hit my third target. It was a very, very nice target. We bounced as expected. We're back to where it started. So if you covered there, and gained the bounce, you can re-enter on a break of this uptrend line right here would be your next objective sell signal. Any marginal equal or marginal new high, it's effectively an equal high. It's a hair below now, but any new high is simply going to extend the divergence and then pave the way for an even bigger drop, which should take us down to that fourth and final target right there. So I'll borrow that one. Divergent high 2 right there. And again, that would be a divergent high, but much more than that, it won't be. Why? Because you start taking out the previous reaction highs and you no longer have that divergence. So that's your update on gold, silver, same thing, divergent high, breakdown of that minor trend lines. There it is. So you have this is it. You want to replicate these trend lines I just gave you on gold, GDX, and silver. If and when they all go, that would be your next sell signal and open the door to the additional targets. Okie dokie, that's a lot. Let me take a look at natural gas. I started the video, I think, right before the inventory report. So we're back. We're still there. We're still at support, 1342. Had an initial knee-jerk reaction, but so far I'm looking at it stabilizing here. And so no change in the outlook. It's long, objective long here at support. Your stop will be commensurate with your price target or targets. All righty, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.